how to read a loan estimate so you can get the best deal. That way, you know exactly, apples for apples, who is getting you the best deal for you and your family. We're going to talk about that here in this video right now. We're going to compare a couple loan estimates. That way you can see where things can go awry, where the confusion can begin, and where a lender can try to hose you, to try to get over on you, to think you're getting the best deal. Well, guess what? They could be misleading you, and we're going to show you how. There's only a couple things that the lender can control in your transaction that can save or cost you money. Number one is the interest rate, which is not all the way in their control. However, when you find a broker, you find someone that's got really good rates, they can kind of control that somewhat. Market will dictate it, but they still have some control over that. So you're looking at interest rate. That's number one. Okay. Number two, you're looking at line item A, origination charges. How much points do they charge into that rate? What's the origination fee? What's the underwriting fee? There may be a processing fee there. So basically, most all of those costs are in line item A. You can look down and see if there's any other cost that's associated with them. That is really where you're going to see the cost. Now, if you look at this, on this origination is $5,599. That's to get a rate of 7.299. Now, that's what they're charging, but not so fast. One other thing you got to look at here is lender credit. So in line item J, you could have a lender credit. So right here of $2,861. That means you have to take that from the origination charge, and now they're charging you $2,700 total. All right, we're going to hop over to the other loan estimate from another company. Now, this is not a loan estimate that you will see when you sign, but this is just one they worked up. So it's not the uniform loan estimate like the first one we saw, because that's actually the one that is uniform and you will sign with every company. Now, the loan amount's the same. Interest rate is minimal difference, 7.375. The other one was 7.299. But now you look at what the cost associated is with this loan. So 2487, 495. So they got points of 2487, application fee of 495, processing fee of 425, and underwriting fee of 375. Those are all fees associated with the loan. The company, that loan company, actually has control over. So that's $3,782. Now, you think, what's the better deal? The better deal all the way, 100%, is the first one. It's a slightly lower rate and saving you $1,000. However, when you go down to the end of this one, it shows that they're going to have to bring $1,000 less with that company. So you may be thinking, oh my goodness, well, they're cheaper. Only thing you should really be comparing is the fees associated with each company. Now, how did it become lower with the second company, and how do they make it look good for you to say, oh, that's enticing, I think I'm going to go with you. You're $1,000 lower. Guess what? They didn't escrow enough. So you got to watch for it. Lenders will sometimes put only 2 months of taxes when you're escrowing. And guess what? You're going to have 6, 8, 10 months, depending on when you're closing. That's how they get you, is that later down the road, they'll say, hey, not our fault. The taxes came in $3,000 more, and that therefore you had to bring $3,000 more to closing. Oh, here's how we fix it. We will hike the interest rate up and give you a credit for that, and you'll be fine. You didn't get the better deal. Only things you should be looking at is the interest rate and how much they're actually charging you. Watch out for it. Just watch those things. See you on the next one.